Hi, everyone. Thank you for being with us. Sorry about the change of time. I know we were going to be on earlier this morning, but there was some last minute changes that has to have to do with the latest rental activity that was part of the guidance that was given to us by the latest by the IRS. So I wanted to make sure that we had all the information, and now it is in here, and I'm gonna go over it. So if you have any questions, please type them into the question box. The purpose of today is to be able to give you a good overview of the 20% Section 199A deduction, but specifically having to do with Schedule C. Because if we start understanding Schedule C, it's a better way for us to understand the entire new law, because it could get very complicated if you start looking into S corporations, partnerships, and all that such. So let's dive right in. And again, please let me know if you have any questions. We are recording this. We're going to offer it live on YouTube and Facebook, so you could be able to see it at a later time. So the purpose of today's presentation, we're going to be covering who qualifies for this new 20% deduction, limitations as your profit increases, tax planning strategies to increase the deduction, easy to understand examples, and also we're going to have an open question and answer session to answer any of the questions that you may have. So first, what is Section 199A? Section 199A allows taxpayers other than C corporations a deduction of 20% of qualified business income. So first you need to calculate qualified business income, and then you're able to take 20%, up to 20% of that as a deduction. But the qualified business income must be earned as in a qualified trade or business, subject to certain limitations. Also, the deduction only applies to income tax. It does not apply to self-employment tax. So it's not going to reduce your self-employment tax. So you still have to pay that. So the benefits of the Section 199A deduction, it reduces taxable income, which reduces tax. So everybody wants to pay less tax. So great, there's a deduction that allows you to do that. The disadvantages is it's complicated. There's limitations depending on how much income you earned, type of business you have, etc. But the fact that it's complicated, that's good news, right? For us as tax professionals, we're able to take on the clients, and maybe they're going to come visit us instead of doing it themselves or anything else. So yeah, that could be good. So no worries on that. Three major concepts to understand. Number one, it only applies to pass-through entities like sole proprietorships, which are Schedule C, partnerships, S corporations, real estate investment trusts, rental activity. Like I said earlier, it could be the case for them, for individuals to receive a deduction for rental activity. It reduces taxable income, which in turn reduces tax. And these two numbers, 157,500 and 315,000, these are your magic numbers. Keep these in mind. That's going to determine if you qualify or not, or if you have to apply other limitations. So what is qualified business income? Let's begin by defining that. It includes the net amount of qualified items of income, gain, deduction, and loss with respect to any qualified trade or business of the taxpayer. It excludes short-term and long-term capital gains. It excludes interest income, and it excludes C corporation dividend income. So usually it is your net income. Like for a Schedule C, sole proprietorship, you have a Schedule C, it's going to be your net income most of the time. That's going to be your qualified business income. If you have rental activity, it's going to be your net rental income after you take the losses. That's your Schedule E. That's what the qualified business income will be most of the time. Again, when you have a Schedule E. Now, if you have a partnership, it's whatever the K1 is. So if the partnership has, say, $100,000 of net income of profit, and there's two partners, and they're 50% each, there's going to be two K1s, right? And each K1 is going to have $50,000 in there because the net income gets divided by two, 50 for one partner, 50 for the other. Now, that's the qualified business income of that individual. It's going to be the net income of the K1. The same thing with the S corporation, that is the K1 net income. So if there's only one shareholder, well, it's going to be the K1, the net income that shows up on that K1. But if there's multiple shareholders, the net income of the S corporation gets divided accordingly based on the percentage of each shareholder. And whatever each individual shareholder, their share of the net income, their percentage, that's going to be their qualified business income. But like I said, today we're not going to talk about that. That's the next webinar. Right now, let's just focus on Schedule C to help you understand the basics, and then we will graduate to these other entities. Section 199A, it's a pass-through entity tax cut that gives the owners of pass-through businesses like sole proprietorships, partnerships, S corporations, and real estate investors a deduction of up to 20% of qualified business income. So again, reiterate that, just keep that in mind of what that is. It is not for C corporations. If you have a C corporation, this does not apply to you. So what are the benefits? How do you calculate the tax savings? Let's look at an example here. On the left, let's say somebody that is single makes $150,000 has $150,000 of taxable income. Now, looking at the 2018 tax rate, $150,000 of taxable income, it has a 24% tax rate. This person is going to pay $36,000 of tax. Now, the right side here, the same person, single, makes $150,000 of taxable income. Let's say that this person has a qualified business income, a deduction, a Section 199A deduction of $20,000. How? I just made that up. I put that in there. After we did the calculation, it came out to $20,000, right? So let's assume it comes out to $20,000. But what does that mean? That means that that taxable income is reduced. So now the new taxable income is only $130,000. Do you see how the QBI deduction reduces taxable income? So why does that matter? Because at $130,000 taxable income, you're still at a 24% tax rate, but 24% of $130,000 is less than 24% of $150,000, right? Because 24% of $130,000 is $31,200. So what's less, $31,200 or $36,000, right? Do you see the benefit? As you can see, this deduction, what it does, it lowers taxable income, which then lowers your tax. That's the benefit. That's what happens. Tell your clients that when they go and they're confused about it. There's nothing else much to it. That's what it does. So keep that in mind. Now, things get tricky when you go above the magic numbers. Remember the magic number, if you're single, it's $157,500. If you're married, it's $315,000. These are your key numbers. If you're below those key numbers, don't worry. Everything's all gravy. You're going to get, for the most part, that deduction. If you start going above those numbers, and these are taxable income numbers. If your taxable income is above $157,500 if you're single, or if your taxable income is above $315,000 if you're married, then there is going to be disqualifiers. There's going to be limitations. One of the biggest limitations is having a specified service trader business. If your business is defined as a specified service trader business, and if your taxable income is above these magic numbers, then you may get disqualified. You may get limited. There's going to be situations that are not going to be good, but it's only if you're above. So most people are going to be below. So, don't worry about it too much. But let's dive in a little bit about what is a specified service trade or business. So the law defines these types of businesses as the fields of health, law, accounting, actual science, performing arts, consulting, athletics, financial services, brokerage services, or any trade or business where the principal asset of the business is the reputation or skill of one or more of its employees or owners. That is what a specified service trade or business is. So if you have a specified service trade or business, and if your taxable income is above the threshold, then it gets complicated. There's going to be limitations. You may be disqualified. If you have a specified service trade or business, and if your taxable income is below the threshold, doesn't matter. You're going to get the deduction anyways. As you can see here are the numbers. Single, $157,500 taxable income. Married, $315,000 taxable income. Being below, doesn't matter what kind of business you are, you're going to get the deduction. If you are above, no deduction. If you're within, there's a deduction, but it's limited. So keep these numbers in mind. The bottom numbers and the top numbers. Let's look at an example that's going to help us understand this better. Let's say there is a tax pro. His name is George. And let's say that George works for himself. Maybe he works for H&R Block. He's an employee. He earns $50,000 in W-2 wages as an employee. He also on the side has a side business. Maybe he does taxes on the side, like on the weekends or after hours. And his business, which is a Schedule C business, nets $100,000 of net income, of profit. So George has two sources of income. He has a W-2 for $50,000. He's an employee, but he also has $100,000 of net income under Schedule C. So first, let's combine this. So the total income is $150,000 total income, right? You add it up. Now, let's arrive at taxable income. So we're going to take away the single standard deduction, take away the self-employment tax deduction. The point is that George's taxable income is $130,935. Now, is that below the threshold? Remember, he's single. Somebody that's single, his threshold is $157,500. So yes, he's below the threshold. That's good. So even though he is a specified service trade or business, because he's a tax pro or an accountant, it doesn't matter really because he's below the threshold. So he's going to get the deduction. But how do we calculate that deduction? So you need to take 20% of QBI, qualified business income. QBI in this case is $100,000, right? Because that's the net income of his Schedule C. So 20% of QBI or 20% of taxable income. So 20% of QBI is $20,000. 20% of taxable income is $26,187. In this case, the lesser amount is $20,000. So guess what? His deduction, Section 189A deduction is $20,000. That's it. Easy, done. What does it do? It lowers his taxable income. So his new taxable income is only $110,935. It used to be $130,935, but because he has a deduction, it lowered it to $110,935. So this goes on line 9. Line 9 is where the deduction, the QBI deduction goes. So line 10 will show his new taxable income of $110,000. So again, less taxable income, less tax. That's it. Easy, right? If you have any questions about this example or other examples, please type them into the box, the question box, and we'll be sure to answer them. So we want to make sure we're answering all the questions. So next year, George, it's still George, but next year he said, you know, I'm going to go off on my own. I'm going to quit my job at H&R Block. I don't want to be an employee no more. No more W-2, no more employee. He's all on his own. He still makes the same. He makes $100,000 still, again, on a Schedule C. So let's do some math. So he makes $100,000 minus standard deduction, minus self-employment tax deduction. His taxable income for this year is $80,935. The first test, is he below the threshold? Yes. The threshold for somebody who's single is $157,500. He is below the threshold. Great. It doesn't matter if he's a specified service trader business or not. He's below the threshold. So let's apply some more math. So what's less? 20% of QBI, which is 20% of 100,000, or 20% of taxable income. In this case, taxable income is 80,935. So 20% of 80,935 is 16,187. That is less than 20,000. Therefore, in this example, his deduction is 16,187. Easy, done, we got it. So what does that do? Is, again, it lowers his taxable income. So his new taxable income is 64,748. We're done. There you go. See, it is easy, right? It's easy if you just look at basic examples. So hopefully a lot of you are understanding this. And again, if you don't, please send us a question. I'm looking here if there's any questions. I don't see any yet, but let's look at another example. The following year, George marries a nice, lovely lady, and she makes a good amount of money. So his new wife makes $150,000 at her job. She's an employee. George still makes the same. He makes $100,000 net income from his Schedule C. He's still a tax professional, which means he's still a specified service trader business. So let's look at their combined income. Their combined income is $250,000. Subtract the marriage finding joint standard deduction. Subtract self-employment tax deduction. The taxable income of this couple is $218,935. Is that below the threshold? If you're married, remember, the threshold is $315,000. So $218,935 is less than $315,000. So again, in this example, even though they made more money together, they're still below the threshold. So beautiful. It's all good. Easy, right? Let's do some math. 20% of QBI, 20% of 100,000 is 20,000, or 20% of taxable income. 20% of taxable income is 43,787. So in this case, the deduction is 20,000. What does that do? It lowers their taxable income. So their new taxable income, because of their $20,000 deduction, is now $198,935. So because George has a Schedule C business, he's able to get that QBI deduction, and it lowers their taxable income together. So that's how it works. It's not too bad if you see these easy examples. So hopefully that is helping you understand. Now, let's say the next year. So this is year after year, because remember, the new Tax Cuts and Jobs Act is for tax year 2018 through 2025. So it's going to happen every year, right? The next year, George does great. He now makes $300,000 profit. He triples his profit. His wife is still making $150,000. So let's do some math. Combine the income for $150,000 minus the deductions. Their new taxable income is now $421,983. Uh-oh, that's too high, because the top of the threshold is $415,000. So For somebody that's married, it's between 315 to 415. That's the phase out. Because they're above 415,000 taxable income, guess what? No more QBI deduction for George. It's over. That's it. Why? Because he's a specified service, trade, or business. That's why. If he was not a specified service, trade, or business, if he was a restaurant or a construction company, maybe he would get the deduction still, but that is another equation with another set of limitations. But don't worry about that, because guess what? George is a specified service, trade, or business. His taxable income, along with his wife, is above the threshold, so he does not get any deduction. So what could George do? Maybe George could lower his profit. How? Maybe he wants to hire some employees. Okay? Isn't that a way to boost the economy, hire employees? He may want to hire employees, have some more costs that is going to reduce his net income. And if he reduces his net income, he may be now below the threshold. So that's how it works. See, this is an example, again, of a specified service, trade, or business. We saw how he was eligible. Below the threshold, he's going to get it. It doesn't matter. Above it, he's not going to get it. Zero. If he's within it, it's going to be limited. He's going to get it, but a little bit less. So I don't even want to show that because that's complicated. Just be aware of this example. Now, let's look at another group of companies. Now, let's look at a company that is not a specified service, trade, or business, like a construction company, a landscaping, a restaurant. This is not a specified service, trade, or business. Companies that are not a specified service, trade, or business could still get the deduction even if their income is really high, but they have limitations. Limitations on the wages of the people they employ, of the assets they have. So let's look at some example. Let's look at Maria's Tacos. Let's say she has a restaurant. She is not a specified service, trade, or business. Let's say Maria, her taxable income is $350,000. So this is way above the top of the threshold. Because remember, the top for somebody that's single is $207,500. So she's above. If she was a dentist or a specified service, trade, or business, a doctor, an attorney, she wouldn't get anything. Easy does not get anything. But because she's a restaurant, she may still get a deduction. But let's see how it works. So out of her taxable income, she has a Schedule C business. The Schedule C profits $250,000 of net income of profit, right? So that's the qualified business income, the profit, $250,000. So of that, she employs maybe one worker or maybe two. She has $20,000 of W-2 wages in that business. She does not own any property. The business does not have any assets. So let's look at the math here. How it works is you first take 20% of the qualified business income. So 20% of 250,000 is $50,000. Then you look at two things. You look at first 50% of the wages. So 50% of $20,000. Now, again, these are the wages that are associated with her business. These are employees that she's hired. So 50% of 20,000 is 10,000, and compare that to 25% of the wages plus 2.5% of the unadjusted basis of the assets that she has, that the business owns. So doing the math, 25% of 20,000 plus zero, because remember the business has no assets, no property. It's zero. So the point is, first, in the bottom here, you take the greater of. So 10,000 is greater than 5,000. Then after that, you take the lesser of. 10,000 is less than 50. The deduction is 10,000. It's a little complicated, right? You first take the greater of two calculations, and you get that number, and then you take the lesser of another calculation. But hopefully, this gives you some example. Her deduction is $10,000. So even though she has an income that's way above the threshold because she's not a specified service trade or business, she may still qualify for a deduction depending on the amount of employees she has. Because if she would have more employees, if her W-2 wages would be higher, she may be able to get a bigger deduction, right? So do you see how the way the law is designed, that it's designed for companies to hire more employees in a way? So that's how that works. So hopefully that wasn't too confusing. Let's look at another example here at a rental activity. So Simon Property Group, this Simon, he's a single taxpayer. He has $1 million of taxable income. $1 million is way above the threshold, right? But he's not a specified service trade or business. So you take $100,000 net income. Let's say out of the $1 million that Simon has, only 100,000 comes from a Schedule E, right? $100,000 net income. That's your qualified business income. There's $50,000 in W-2 wages that are associated with that rental activity, with that business, and there's $600,000 of assets. So maybe the rental business has 2 properties and they add up to $600,000. Now, that number is the unadjusted basis property. So the purchase price of the homes or the assets, not including land. So it's the depreciable cost of the assets before they get depreciated. So it's at the time of purchase without including that, right? Anyways, let's do a quick calculation. First, you take 20% of QBI. 20% of QBI is $20,000 because QBI is 100,000 in this case, right? You compare that to the greater of 50% of the wages. So again, there's $50,000 in wages. So half of the wages is $25,000, or 25% of the wages plus 2.5% of the unadjusted basis of the asset. So 25% of 50,000 plus 2.5% of 600,000. Do the math. That equals to 27,500. What's bigger, 27,500 or 25,000? 27,500 is bigger. Now compare 27,500 to 20,000 up here. What's less? 20,000. So the deduction for Simon for his Schedule E business rental activity is $20,000. Ta-da! Hopefully that did not confuse you. Is there any questions at this time? If there is any questions, please let me know so we could be able to answer them. I have a bonus session that we have last minute here. Let me see if I find it so I could send it over. In the meantime, please send your questions so we could go ahead and answer them. Here we go. I found it here. Perfect. So we are going to share this. It has to do with rental income. It's a last minute bonus session. Again, it's the reason why we were not able to start today at 10 Pacific. So let me actually share. Stop sharing. You share the other screen. Here we go. It has to do with rental activity. I think everything is good. So there was some guidance released earlier this week regarding if rental activity is deemed a trade or business, because that's the key. Because for a taxpayer to receive a Section 199A deduction, they get a deduction on a business. Is a rental activity a business? We were debating that for many, many months, and the IRS finally gave some guidance. So let's dive right in and to see what that is. So a business must first rise to the level of a Section 162 trade or business before it is capable of producing income eligible for the 20% deduction. In the Grotzinger case, the Supreme Court stated that to rise to that level of a Section 162 trade or business, the taxpayer must be involved in the activity with continuity and regularity. A sporadic activity, a hobby, or an amusement diversion does not qualify. So again, to be considered a business, more specifically, they call it a Section 162 trade or business, the taxpayer must be involved in the activity continuously and on a regular basis. So Revenue Procedure 2019-7, which was released earlier this week, provides further guidance on whether a rental activity rises to the level of a Section 162 trade or business. The procedure says that it will rise to the level of a trade or business if separate books and records are maintained for each rental activity, if 250 hours or more of rental services are performed per year for the activity, and the taxpayer maintains contemporaneous records, including time reports or similar documents of the rental activity. So if all these three things are in play, great. That rental activity is considered a trade or business, which means it qualifies for a Section 199A deduction. Now, keep in mind the time reports or similar documents must include hours of all services performed, a description of all services performed, dates on which such services are performed, and who performed the services. That needs to be in play for the IRS to consider that activity a trade or business. So you need to be involved, right? You can't just be kicking back, hanging out, and it's passive income. You have a property manager or something. You need to be involved in the business in order for you to have, for you to consider it a trade or business. And again, the reason you want to consider your rental activity trade or business is because it can qualify for a Section 199A deduction. What are some rental services? You have advertising to rent, could be a rental service, negotiating and executing leases, verifying tenant applications, collection of rent, daily operation and maintenance, management of real estate, purchase of materials, and supervision of employees and independent contractors. All these are considered rental services. Is there any questions on that? Ooh, there is a question here. Perfect. Let me pull up that question. By chance, will we be able to access a recording of the webinar? Yes, we are recording this webinar. It'll be posted on YouTube. So follow us under Latino Tax Professionals Association in our Facebook. It's going to be posted there as well. And we could also share the slides with you. Finally, keep in mind that a Section 199A qualified business needs to have income that is derived from the conduct of a trade or business within the United States. So they need to be in the US. So is there any questions at this time? Hopefully that helped understand some of the Section 199A confusion. Again, you saw I covered Schedule C and Schedule E. Easy, not too complex. Partnerships, corporate S-corps, that gets, it's not too complicated, but you got to take some time to understand that. That's why let's cover that next time. Let's not even jump in that. But if you love the presentation, if you love what we're doing, I invite you to go to our national convention in Las Vegas this summer, July 30th, 31st, and August 1st. We're going to have 3 days of classes, networking and fun. And we have a bigger space this year. There's going to be way more space in the room. There's going to be food there at the location, and we are always improving it. So we've got a lot of feedback from last year, what we could do better. And we're ready to rock and roll. So hopefully you could join us in Las Vegas this summer. There's going to be great speakers and a great events as well. Thank you. Gracias. Please let us know if you have any questions. Follow us on YouTube, Facebook. Also, we have a podcast. We just interviewed earlier today John Hewitt, the former CEO of Liberty Tax. He now has a new brand. And guess what? He is looking to start a Hispanic brand, a Hispanic tax brand. Very interesting what he said. So look for the podcast because it's going to be released this tomorrow. And it has an interview with him about the future of the tax industry and why he is deciding to start a Hispanic brand. So we're doing a lot of stuff. Follow us, subscribe to us, and buena suerte, good luck. We'll see you soon. Thank you very much.